Hi guys, welcome to everyone, and hope you can hear me nice and well. Thank you guys. It really has been excellent. Well, it's been a pleasure, guys, and it's been a week since we chatted, and I sincerely hope that you found some fruitful insights for you to trade out of based on what we discussed last week, or some of the things that I showed you from the way that I look at price action. Now, what I want to quickly do is just have a look at what I'm currently looking at the present moment. And then after that, we will have a look. We'll take some time to have a look at the setup, the weekly setup, as we've always kind of looked at it. So here's a few things. On the euro to the dollar, again, just to recap for those who are joining us for the first time. I've got three currencies that I'm looking at, and I'm trading off the 5-minute time frame. So I've got the euro dollar, and you just have a look at what you have at the bottom here. I'll talk through the kind of setup, what I look at when I'm looking at my laptop. So there is the euro dollar, there is the USD CAD, Kiwi, and then there is the yen. Now I'm trading the majors, and as we go through, if I just say the euro, the CAD, or the Kiwi, remember I'm not trading crosses, I'm just trading just the majors. So currently, with the euro, I'm looking, well, I was down here just after the open. Let's have a quick discussion about that. And I had this 3-push pattern wedge, 1, 2, 3, which kind of broke below a little double bottom created out of the low from the late part of the US session yesterday. Then we had a double bottom, and I was looking to see if I could get a higher low somewhere within this region, but we didn't get that, so I didn't take the trade. Well, there was no trade for me to take because it's bottom of a trading range. What I would have wanted to see the low of the 3-push button, the wedge, and that low creates a double bottom. So I wanted a higher low or another test sometime. So we didn't get that. We had a bit of an acceleration, which all it did was accelerate to the top of this trading range. So we are in a trading range, and this trading range is essentially a breakout mode because it's occurring within the first hour and a half or two of the open. So we're in breakout mode. We have a high, we have a low, and now we've got to wait to see which way the market is going to break out. At some point in today's session, I'll be talking about measured moves, not yet, but I will let you know. I'm going to focus on that a little bit, but we'll get to that. The other pair that I'm looking at, Kiwi, USD CAD, and again, you see a variation of a wedge, again, something that happened at the open. And when I say a wedge, remember, it's a 3-push pattern, and it could be a form of a triangle, but any 3-push pattern is a wedge, and it gives us a lot of information, opportunities to trade. So what we had on the open, within the first 8 or so candles or bars that we had, was this double top. Now, if you have a double top near the open and you set up perfectly, that's a good trade to take. So as it was forming, double top at the moving average, so you have that move double top at the moving average is a pretty good trade to take. And when I say good, I think I mentioned last week, I'm always at best considering that I have a 60% chance of winning. It could be more depending on the setup, but because we ended up with a tail at the bottom there, that's not on a double top, because tail here and tail here, the base was strong enough that it given us a signal, a two-bar reversal like that. So I pulled that off. Now we then had a breakout, little breakout above the double top. So when you have a breakout above the double top, and the market turns, you essentially have a wedge, because that's a first push-up, second push-up, and then third push-up, which happen to test the breakout point. So from there, now market creates another double top, and I was looking for a lower high, and to accelerate to the bottom of the trading range, and I didn't get that lower high, so just gotta wait for it. Then the other currency pair that I'm looking at on the 5-minute time frame is the USD yen. So I'm just going to have to wait again. That's going sideways. But when I say going sideways, we have a trading range in here. It's kind of a V-shaped trading range, but it is a trading range. And at this point, we didn't get a clean double top. So I'm not considering that going short in this particular moment when hours here in the open. I would not consider going that short at all. Still a bullish strength. Market didn't turn there, but what's happening now is that we're going sideways. So I'm going to wait to see what actually happens with this pair. I'm going to need to see how we break out of the trading range that's been formed. So that's what I'm currently looking at. So just before we go into the weekly setup, which is always something that you need to do, if you get a chance, do it over the weekend, Sunday. If not, when you get to trade, the very first thing you do, it's important to have a look at the higher time frames and your overall setup. I've kind of taken off some lines, put some lines, because we're starting to talk about the way I approach the markets. But what we need, what you find as you progress in this particular approach, is that what you have will typically not change. The longer time frames will not change. So what we're going to be doing, guys, we will come back every now and then to these charts, to the 5 minute, and see if anything sets up, and then we can talk about how to take a trade. Last week was quite interesting. We stayed through and waited quite a bit, but I pointed out what we were expecting or anticipating and what to do when market set up. And as it turned out, in the zones that I pointed out what to look out for, we had pretty decent setups that if you were in the market, depending the time frames and the way you are, you could have executed those. So that's what we're going to try and do. Hopefully we'll get a decent setup, and if we don't, let's talk through what to look out for. Another announcement which you get from the administration team at some point is that we are moving this show a little bit earlier, 30 minutes earlier, and it will be a 1 hour show, the bar show that I do. So we will start Singapore time next week at 5:30, so 30 minutes earlier, and it will be an hour. So you get that announcement, but let's just bear that in mind. So what I want to do at this stage, let's just look at the euro dollar, and let's look at the setup. So always, you want to start with the high time frame. What I've tried to do is do a bit of color coding, which I think will be easier to follow, so you can see how I'm thinking through these things. So when you see the black hyphenated lines, they are referring to levels of support and resistance that I think are significant, but which are appearing on the monthly time frame. So that's at the highest level time frame. So what we have, if you haven't put it up from last week, on the euro, is this. I did mention that I think 1.3 is going to be a pretty powerful magnet to pull this currency pair up, and so I explained my thinking and my rationale for that. Is this trading range here? So the market went sideways 2015 to 2016. Whenever you see any form of trading range, sometimes it's a couple of bars that you see, sometimes a couple of dojis, but sometimes a prolonged trading range. But whenever you see a trading range, that is a form of breakout mode. In other words, anticipate, expect that the market might break out of that. And if the market breaks out of that trading range, typically, and that's the majority of the time, I mean, we're talking, very high probability the market would like to reach a measured move. If it doesn't reach the measured move, then it gives you information that the opposite side is pretty strong. Okay, so in this case, just a rough measured move from the low of the trading range to the high of the trading range. Measured move is an equidistant extension of the height. So it will get us to here. So if the market breaks out of that, which it did, at that point you would be expecting that the bulls want to reach that level, reach the measured move. The fact that they failed to reach it and returned, it's a descending trend line. I mean, the bears are strong, and they always consider that the bears are strong in the market, and they're not allowing the bulls to make the measured move. So it just gives you information. However, because of this time frame that we're at, and the fact that the low of that trading range is not broken, I leave that measured move there, because the bulls might be saying, okay, we didn't get to it, like one pullback led to, we didn't get to that at that particular moment. But all of this, because of this breakout we have, is a form of a pullback. So the bulls will want to remain in the market, will maintain a bullish perspective. So we leave that there to see if it gets tested at a particular point in time. If the market turns and we take out this low, then that's not a strong magnet, because to pull the market up. For now, it's best to leave it out there, because we've since had information from the move of that first leg to when the market turned to that low. You can also put an extension of leg one pullback and leg two. So that's another type of measured move. But today I'm not going to be talking about that. I'm going to be talking about just this equidistance. But just for our information's sake, that whole move, so we could do this just to see it clearly. Okay, so that's the first move until the market turned. And the market kind of turned there, without the market failed to break through that, so market turned there. And I just put it here. So again, that's as far as a bull, I'll be saying, well, okay, depending where I took a trade and I hold my position, maybe I'll take a bit of profit out of the market, but I'm going to hold a position to see if we get that measured move. Or if after this first pullback and then you see all of this and you come out of the trade, it's perfectly fine. Take all of your profits there. Then wait to see how you get into the market. If you have gotten in, you're not even thinking about that pullback, but if you got in there, your appropriate stop, and we'll talk about this at some other time. Appropriate stop is always at a technical level. Don't just put your stops anywhere, it would have been there. But you'd have been saying, well, okay, I'm taking the trade there. I'll probably take a little bit of profits off if we get to the double top, but the ultimate goal is still to see if we can get that full leg one pullback, leg two, or get to that measured move. And alternatively, that measured move is also in 1.3, big round number. Market tends to get drawn to those. So 1.3 is just a number, a significant number on the euro dollar to keep in mind. Another thing which you could have done while you're in here, and again, I'm not talking to the leg one, leg two moves, but let's put it in just to see what you would have done while you were still down here. You would have said, well, where did the first leg actually start? You could have started there, or you could have started there. Okay, so that was the full extent of that first leg breakout, and then we had a pullback there. Okay, so at that stage, without all of this information, now remember the reason I'm kind of emphasizing this because I want to find out key levels of support and resistance on the monthly, which I'll bring down to my time frame, so that when they appear on my time frame, I kind of know there's something big happening at the higher levels. But markets are fractal, F-R-A-C-T-A-L, which we have said before, which basically means whatever pattern that you see on any time frame. If you didn't see this as a monthly, it could be any time frame. It could be 1 minute, 5 minute, daily, whatever you want to put, 4 hourly, 25-minute time frame. If you can structure that, doesn't matter. The patterns are the same. So if you had seen that and said, okay, I'm going to trade a breakout, or this is a breakout, I took a trading range entry here. Let me see what happens to at the top to the 10. No, we had a breakout, follow through, fantastic. Now hold on to my trade and see if we get to the measured move. Okay, that's measured move is the highest profit. That's why the leg one pullback, leg two is the highest profit. The measured move would have been the earliest profit. I always prefer to set my profit levels either at the earliest profit or in between, not at the top, because you might get a sudden reversal, pretty dramatic reversal. On the monthly, it might take a bit of time to form, but I always try and take it a little bit earlier, take more a little bit earlier. If you had not participated in all of this, it's also still fine. I mean, I do miss a lot of trades because I'm not comfortable taking a particular trade because I don't see the setup. So if for any reason you had not taken this Monday, I was not sure what application. Okay, the moving average I'm using, Alan, is 20 moving average. That's the moving average that I use. And I use that constantly, except when I get to, when I think that I'm in a possible breakout. When I see a breakout, then what I want to do, I shift that to a 10 moving average, but I'll talk about that. But standard moving average is the 20 EMA, exponential moving average on the close. That's the standard moving average. So in any case, if you've missed all of that and you've seen that breakout, you can come in and enter the trade here. You can come in and enter the trade here. There is a window that keeps popping up, which is blocking my view. I don't know if it's blocking your guys' view. Let's see. Floating it. Okay, I'll leave it this here. So you could have taken that breakout, pulled back test of the breakout. You can take that. The only thing is taking a trade there. Your stop has to be down here. But remember, you want to have seen all of this. And your thesis is if I take the trade here, if my stop here, I'm going to expect to get a second move up. But if you take that second move up, and then the market immediately turns like it's done here, you can always come out of the trade. Maybe if just break even on the trade, but you must come out when the market turns, with a descending trend line there. If it breaks above that, then you wait for your profit levels. So that's how I would have structured that. I moved something just now. I was moving things around. Don't worry about it. So the other thing that we have here, remember these black dashed lines, you see them as they appear in the lower time frame chart. Is this descending trend line? Let's have a look at that. You see that descending trend line started from that level, and I would have just connected it all the way down. So at some point, the market moves towards that. The bears that have created that are strong enough to keep the market bearish. So it is bearish until we break above it. We did break above it here, so that gives the bulls confidence. Any bull is taking that trade, feel pretty confident that they're going to be broken above the trend line. A pretty decent bar in the month of July. We had a follow through. The market tried to turn it back, but then we had a reversal up. So bulls are feeling pretty confident. So that magnet is still very, very attractive for them, the 1.3. So bulls will keep on finding opportunities to take trades, and they'll carry on. But as far as we're concerned, trading on the lower time frame chart, we've got that high marked, and we'll observe it as we go down to the lower levels. Then also on this particular chart, another level that will be key for to mark is we have that breakout. Market comes back to test that breakout point, create a new higher low. So we just mark that low to see what happens as we go down to the lower time frames. Okay, so what we'll then do is from the monthly, unless it's the end of the week, the Friday, I just go straight down to the daily. I don't go to the weekly time frame when I do the setups. I'm just interested in the highest level time frame, which is the monthly. The weekly, if I happen to be trading on a Friday, which I do on quite a few occasions, becomes important because it's the end of the week, and the weekly time frame plays a role. But I just jump from the monthly and I go to the daily. And I'll try and hide the floating mixing control. I hope I do not hide many things. Okay, that wasn't the correct one. All right, I'm gonna leave it there, guys, and just hope it doesn't disturb this to fade away. I then come down to the daily time frame, and when I look at the daily, I'm looking at what are the most prominent levels of support and resistance that I can see on the daily time frame that I need to worry about. So the first thing is just have a quick look, and there are two levels that I have marked: this high and this low. Those are important. Now I've coded them in blue. So blue stripes is what is immediately apparent, what is coming my way based on the daily time frame, because I'm trading intraday. The daily levels of support are extremely significant. I need to know what those are. I might not, always pick them up, but sometimes you become so engrossed watching or managing a trade, you may miss out on something where you might want to take profits, or where you might want to initiate a new trade on a different pair, whatever the case may be. So those two are pretty important. So you see them. I now because I have two, if you look at the bottom, I have two charts per particular pair. I then take these blue marked levels and those I plonk on my 5-minute time frame. So there they are, they're on the 5-minute time frame. Okay. Everything else that is there, like these black dashed lines, which are coming from the monthly time frame, they remain on the chart that's got the daily and the monthly, because I don't want to clutter a lot of things. So I would have seen on, that, okay, we still got this, that's 1.195 level, pretty critical. There's this low, which I would have marked out of my monthly time frame. It's also here on the daily time frame. If assuming yesterday had been a strong bear trend bar, then that would have been pretty significant for me to watch out on the day. Okay, then I would have taken that and marked it on my 5-minute time frame. So as it is, I just marked those nearest levels. Plus, I also then looked at the high and the low of yesterday, and all I do with the high and low of yesterday, I marked that high in red. So the low in red, that's the low of yesterday, and high of yesterday is marked in green. And that's all I've extracted from my higher time frames. And now with that, I can now start to focus on what's happening on this immediate, on my trading time frame. Now, the other thing I would have picked up, sorry, of course, is the open. So the high of yesterday, the low of yesterday, and the open of today. I'm very interested to know the open of today, because the market may gravitate to the open of the day, end up with a dodgy of sorts, or that fight between the bulls and the bears may carry on for a long time. As it is now, if you look at the European session, we are currently almost in the middle. The trading range, the open of the day is in the middle of the day. So it's pretty significant at the moment. We're above it, but we're below it. So we're going to have to wait and see how the market unfolds from there. So that's what we're looking at on the euro. I will come back to talk about measured moves and what else I see when we talk about that. The other chart that we look at. So let's just, so here I am doing nothing, okay, because we are in the middle of this trading range. You don't want to initiate any trades in the middle of this trading range. Now, the only time that you would consider using the middle of a range for any trade setup is if, for example, let's assume from here, if we'd have had consecutive bull bars and then a breakout, confirmed breakout, which means you need a breakout candle and a follow through. If we'd had a strong breakout, we would look at a 50% pullback, which might end up coming back into the trading range. Because 50% pullback is a pretty significant level. Pullback to 50% of any breakout. We would only use that to see if the market tests that and gives us the first low of a possible trading range that we can then trade. But right now, we don't have that. So we're not going to initiate any trades in here. We want to wait and see how the market resumes, and maybe it tests that or breaks out above that, and we look for our pullback. If you take any trade in here, for whatever reason, I mean, you really are taking a 50-50 trade, because you'll have to, if you were buying, you have to put your stop down there. If you are selling, you put your stop there. It's middle of a trading range. It's a 50-50. If you do it often, you're going to win 50% of the time and lose 50% of the times, and you'll be a break even. There's no way to structure that trade cleverly. You know, you could try and play a scaling in game, which is very difficult to do. So you could say, okay, George, I know where to put my stop. That's a technical level. I'm just going to sell in here. If the market comes to test that level, and if it turns and gives me a double top in the lower high, I will scale into my trade and hopefully get back to break even. You can do that, but then the things you need to put into the structure of your trade make it a little bit complicated. You have to trade very small. So if you typically risk 0.5% on a trade, for example, if you're going to do that, you have to risk 0.25. So you have to go half so that when the market gets back here, you can put back another 0.25. It can be done, but it's a complicated way to structure the trade. You just add more things to your decision-making process, which could be difficult, but it's possible to do that. So just bear that in mind. So we're not trading in that particular manner, but if that's where you trade, yeah, it can be done. So while we wait on that quick zip through to the CAD, market tried to break beneath that. It's tried to break beneath the low of yesterday. So what should you do with this? Again, if the bulls are strong, the bears might try to resume selling. We get a double bottom, and if you get a double bottom, then we can look for a higher low. That would be the best way to look at trading this, because you're at the bottom of the trading range. Market tried to break to the measured move down here, which we talk about, but it failed, which means there's good bullish pressure in the market, but nothing for us to trade at the moment. Yen, okay, we started speaking about this a little bit earlier on. So I'm asking the question, is the open and close line of the previous day bar, is that the trading range that you are referring to? So let me just see if I can answer that open and close line of the previous day. Okay, so we're talking about the euro. Let me just make sure I'm answering the right question. So there's two things when you come down here, that three things. You gotta pick the low of the day, of yesterday, 1.19916, the low of yesterday, which I've been put in there. That's the low of yesterday. The other thing I pick is the high of yesterday, which is 1942, and there is the high of yesterday, which is in green. Then the third thing that you're picking up from the daily time frame is just where did we open today? Okay, so you can pick up the open of the day, 20885, and there's 20885. So that's the open of the day. Now, when I'm saying that we are in a trading range, what I've marked here, you see this dashed purple or magenta line. That's the open of the European session. Now you see it's at 9:55. I just put it 5 minutes before so I can see what happened with the first trading candle of the day on the time frame. Okay, so there's a bit of selling there. Now the trading range that has been formed, that I'm saying we're in the middle of the trading range. If you looked at the low of the day and the low of this particular session. Let me just, so if you look at the low of this particular session, it's here, and the high of the particular session is there. So, the high of yesterday is about the open. So I'm saying the high of yesterday is almost the middle of that trading range. I'm saying the open of the day, it's within the middle of the trading range. So that's what you want to trade. The trading range is the range of the day so far. But what you also always need to look left, right? Depending on which side of the road you drive, but you always need to look either side. So we had a high created just before European session. Let's check that out. Which, as it turned out, that high that was created in the earlier session is the high of the Asian session. For the guys who, depending on the time frame, if you trade in the Asian session, the same thing can happen occurs. So the open, I like to mark the open of the Tokyo Stock Exchange. So I just mark that there on my time frame, and again, according to my time, it's 1:55 in the morning. You just work it out your time to see what happened the first of the candle. Then I always mark just with this gray dashed line, the close of the afternoon session. So that gives me a quick view of what happened in the actual Tokyo Stock Exchange time period. But the whole Asian session is this period up to here. So you can see again the high of the Asian session, which we can mark, and just to try and keep a distinction of what is happening. So close dotted lines is what's happening in this particular session, and the close dotted black lines. So that was the high of the Asian session. So between the high of the Asian session, we try to break above it in this current European session, the open, using the open of the London Stock Exchange as the open of the market. So there is again another trading range here. So I find it pretty useful. You can always just do that for yourself. You can take it off because you don't want too much clutter, just to get a sense of, okay, so from the high of the Asian session, at the open at the low, and try to break above that, but we are still within that range that was created from that high to that low. And at this stage, it's 35 pips, which is good to trade. I always trade. If you're on the 5-minute time frame, I recommend that you look to take trades when you see the market having extended for at least 20 pips. Because the minimum stop you want to put in a 5-minute time frame is 10 pips. Just so you don't get picked out or closed out unnecessarily. So 35 pips is a pretty good range to trade. So if we were to get a double top in here, lower high, you could take that trade and say, well, let me see if I can get to the low of the particular range. So I'm hoping that answers your question. Okay, so we're starting to talk about the USD CAD. Again, while we're waiting to see what transpires on that, and then the yen. The yen is breaking out of this trading range that we had. We had that pullback. So a measured move would be there. Now, here's something interesting while we wait to see if we get a trade here. Break out of this particular trading range. That's a good candle close on its low. We had follow through, so good breakout by the bulls. But we've reached the high of yesterday. While we just closed above it, we need to see that the bulls are strong and give us a strong, pretty strong close above this. And once we have that strong close, then we're comfortable to look for long trades in the end. But we need that follow through, break out above the high of yesterday. If we don't get that, and the market turns, then we gotta wait again and see if we get another opportunity to trade a little bit later on. Yes, yeah, that's it. So it's pretty useful to be able to structure your mind around Remember, the Forex market is 24/7, but what's happening in this particular session is important for me to work with. But I also need to see, especially the most recent price action pattern, last couple of hours or so of the last session, because it's 24/7. But what is happening in this session is pretty significant. That's why trading the open is important, but bear in mind trading the close is also important. So 2 hours before and 2 hours after, always keep your eyes on that. Well, while we're talking about the yen, we're happy with that break above that trading range and follow through. But we're right here against a key level of resistance until we break through it. So if the bulls are strong to do this, why are they not showing strength to also give us a follow through, so we know they're strong enough to start to create a complete bullish day? That pause is a problem for me from a bullish perspective, because I need to see a follow through. So we gotta wait and see what transpires. So just keep that in mind. Let's just quickly do the Canadian. Again, in terms of your setups, always start on the monthly. Okay, and kind of have a look. These blues are picked up. I picked them up on the daily, but the key level for me for the monthly is this one at this stage. That's a very key level. Why is that a key level? It's a key level because from this low, the market went and tested a previous high and ultimately created a new high for us. So I've marked that. I mean, it's many months back, but when the price starts to get to that level, then I'll know there's something significant again in the monthly that I must pay attention to. We had that low before, which was broken. That was important because at that stage we didn't know that the market was in create a double bottom and attempt to resume, but it broke through that, and that might get tested again. So we just leave that in place. Then again, you just come down to the daily time frame. Okay. Okay, that level there, which I've marked. Most immediate levels for me is this low here last week, and then this high here. So those are the most immediate levels that I need to pay attention to on this when I go down to the 5-minute time frame. And again, so those levels, when you come down to 5-minute time frame, you just have those levels marked, okay, and you just keep them in your side. Then what happened yesterday is pretty important. The low of yesterday, 2.6, and the high of yesterday, 26979. 26979 and 2.6, high and low of the day. Then we want to just pick up again pretty quickly the open of the day. Where did the day open? 26298, 26298. Okay, so and that's the kind of view that we then want to work with on this particular time frame. So as I mentioned earlier on, because we had it's a micro double top. Why do you call it micro double top? Well, it's micro double top because it's separated by a couple of bars. When you look at how the market has moved, it's really always going to go back to your written down strategy and how you define it. Because you're trading off double tops. When the market in a trading range. Okay, you need to see a double top and then a second range will be in a lower high. It's a double top, it's a double bottom. You want to then see a high or double bottom. But when you see that, you don't want to change your analysis or your assessment of what a double top is, because that's a micro double top. This would only be useful for me if, let's say here, we had a double top. Okay, because now I have that, and I'm trying to find a way to go short. That micro double tops, it's a double top separated by one or two bars. It could either be one candle, then another bull, and then a reversal. With that you can trade, but I can't call that a double top and say, well, hang on, if I see that kind of double top, I'm going to sell it short, or double bottom, I'm going to sell it, because it's not yet. It's a test of that breakout point. Okay, and now I want to see if the bears can resume and create a double top. Immediately it reversed, create a micro double top. So yes, it turned out quite well if you're taking that trade, and you know, and I just try and hold it for long, but you're ready to get out somewhere here or here. But now, you know, that becomes the first double top level for me. If the bears are strong, they've already broken beneath here and did a follow through bar by the pulse. They're pretty strong. There will be another double top here and then a lower high. Then we can trade it short. You know, and if we trade it short from this point, you know, we really want to just trade it, and I'll talk about measured moves shortly. We want to take it short and hold for as long as possible. So there's a way of trading, another way of trading that's called scalping. Where you want to be in and out of the market very quickly. You could take your chance. You know that your success risk will be strong if you see that and maybe take a follow through candle. But your profit level is down here. This is happening, but your profit target will be here because that's the level of support. You know, so you go for very small profit. But what we're trying to find is these good moves and these good that give us 2-to-1, 3-to-1 trades that allow us to hold for as long as possible during the day or during the session, and be able to have an opportunity to scale in and add in. So let's wait and see. So we have a double top. Let's see if we with the first touch of a double top. Let's see if we get another one and then a lower high, and you know, we can look to take that trade. Okay, the yen we've spoken about a little bit. Let's look on the higher time frame, and then we'll come back and look at the daily. Then we can talk about measured moves. Okay, so it's a little bit cluttered because of some of the what I've got marks on the daily. But here's what's interesting. There's this trend line by the bears. Now you see that, you know, some of the overshoots I've just ignored because I'm looking at where prices tend here, but then now we're here, tend here. But the bears are strong. Every time the bulls try and break above it, it turns. Break above it, turns. So this very interesting day, a month in March. I think that was the whole breakout into COVID and all the repercussions that took place. But you know, a huge dojo, a huge trading range, and that's still significant. But the market is turned here, so we can almost kind of ignore that overshoot. So that low is important. 1.2591 the monthly. That's to appear for us. That's a pretty interesting low. In terms of the descending trend line, if the market gets to that, the blues are on the daily, get to that. The market gets to that, you know, coming to a level that the bears have reappeared strongly in the market to defend that whole trend line. Now, the thing that's happening at an overall level is the market is getting into a breakout mode. It's almost because we're starting to see a converging triangle. A converging triangle is breakout mode. The market will break out of that. So what you're not sure of is, are the bulls 2 successive months so far going to be able to put another very strong month and close above this, which will be the first sign of strength. If they close above this, then they would need a second month in April to confirm their strength, and we know we might get a bull trend. But if they fail to do that, they will test that break above it, maybe a little bit, and then there'll be a lot of aggressive selling to create one of these tails that we've got. So from there, we just come down to our daily time frame. Okay. Now, the reason I've drawn the 107.4 level on the daily time frame is because of a potential measured move of the breakout point. So the market broke out at this level. You can see this bull move here. Then we had a pullback, but the height of the breakout itself creates a measured move. So if the bulls are strong, they want to see, after a pullback, whatever pullback we got, they want to see an equidistant move of the breakout that created. That's where we have that there. So if that appears on the daily, I'll know where the bulls are trying to go. We also have another level, which I just marked here. At this stage, it's a lower high. But that lower high and the subsequent double top ended up creating this low that created a double bottom. So I've marked that just to see if the bears return the market here after the bulls attempted to break out are going to reappear pretty soon. And if they appear pretty soon, if the bears want to defend that level on the daily time frame. All it means is we might get a double top out of today, and then aggressive selling to trigger a sell beneath here, or that same level where the bulls appeared. If the bulls are strong enough to repulse the bears, they will have to close above this, and then they want to go to their target is here. That's what that's their market. It's not too far, 44, 45 pips. That's measured move. That's where they want to get to. They want to get to that level as the first target. That's what the bulls want. And if the bulls get there, don't be surprised. Let's assume they get there today or tomorrow. If all of a sudden you get aggressive selling, what we need to remember, two things are happening. The bears would have started selling at the high here to defend that level we saw. The bulls will be selling out of their profits, because if you're a bull, you bought, you need to sell to make a profit. So they'll be selling from the bulls and they'll be selling from the bears, and that selling will be strong enough to push the market down. Then we start to have a wedge, 3 pushes being confirmed and formed here. But again, the goal will be only to get to the moving average, because we are still in a bull channel. So all of that information, then we take it down to our 5-minute time frame, and we just plonk it on a 5-minute time frame. Now, as the day progresses, what I then do is best just to switch the direct time frame to an hourly, because continually looking at the daily is not going to help you much. To look at the end of the day, but the hourly time frame, I just so it's the same chart that would have read my monthly and daily. I find it pretty useful, and the reason I find that pretty useful is just to keep a glance at it. And sometimes you might get bull breakout or a bear breakout, that's pretty clear on the hourly, but you just can't get your pullback. You can't see the decent pullback that you're looking for on the 5-minute time frame. But if it's clear that we're going up on the hourly, number one, you got to find out, determine where do you put your stop on the chart that you trade. That's the 5-minute chart. Put your stop in the technical level, and you know there's a pullback, but I can't see my two leg pullback, high one, high two. I can't see my wedge, but I can see the market is going up. I don't want to sit for 2-3 hours and the market is moving. Then in the third hour, now I see my pullback, but it's moved so much, and my stop is still way down. Now you hesitate, and the market keeps moving. Just go, flip to the hourly, see, okay, we're moving up. Where do I put my stop correctly on the 5 minutes, and then take a trade. Okay, so that's where we are now, and we are actively looking for our trades in the market. Okay, so at this stage, we're going to have to wait and see how the market, if the selling carries on, are we going to create a proper double bottom here? And how are we going to get to that double bottom? So you can see, there's a low there that was created. There's another low. Are we going to get there maybe with a 3 push pattern, which would be good, because if you get there with 1, 2, 3, what it means is that the bears have tried to accelerate downwards 3 times. Once failed, second time failed, third time failed. If again at the third time a double bottom is created, that would be excellent news for a bullish paradigm, bullish outlook, because then all you wait for is a decent high low, and then you want to take your trade going long. And if it sets up like that, you might not be surprised to see that although you might want to take your first profits at this level, in which you can, you might get a very strong bullish leg forming, which might go for a long time to this session and possibly into parts of the US session. So let's wait. That's you probably hear that refrain a lot from me. Let's wait. Let's wait for the setup that allows us to trade comfortably, that allows us to be able to make a lot of profit in terms of our percentage of return. Because if we do get the setup and we take the first setup and we get the move with a lot of return ahead of us, but also we might get a chance to add on to the trade, move our stops to a proper technical level, and the first trade is breaking and to kill on like that. So it's worthwhile to wait. What could be the inverse of this? The inverse of what we're seeing here is if out of this middle that we have, we start to get acceleration up. Well, start to get acceleration up now, we've got to ask ourselves, market tried to break up above the high of the Asian session. Are we going to get a double top here? Or are we going to break above it, come back to test, and then take the trade? So plenty of opportunity if we just wait. Now, again, I have to keep saying, because I know all of us have different structures to our mind and different ways that we trade. If your mindset is able to trade at a much higher frequency than I'm showing, which means you can take your trade, you know that if it turns, you can exit out of it, take a few pips, that's perfectly fine. So I'm not saying that you can't trade that way. You can, but what I'm showing you is the 60-40 trades, which a higher probability. Remember, we said 60-40 is 60% chance that the trade will work my way. Out of 10 trades, I'll win 6 and make decent returns, 2-1, 3-1. I'll lose 4. And unless the reversal is dramatic, I should be able to exit before I get my stop hit, because I can see, okay, market is gone up, its failed, is coming back. But if there's an immediate reversal, excuse me, guys, that's perfectly fine, because then I manage my stop, because I know that's in my control. And I get stopped out. That's fantastic. I can wait to take a proper trade. So let's wait and see. I'm just going to do another just flip through, then we can come talk about measured moves. Now, we spoke about the Canadian at length. So far, this market went up, tried to break out again, and we have this area here, which was a test of the breakout point, micro double top, and I say that we got to consider that as the first touch of a potential double top trading range. So if we get a double top here, that becomes the second touch. Then all we want is just to see the lower high, which we can trade short. If that fails, the market fails to create a double top, in other words, we have acceleration above that level and above the open of the day, then the bulls are showing strength. We need to make sure we have a breakout candle above the high of the day and a follow candle, which is still a bullish candle. Then we know, okay, bulls are strong. Let's wait for pullback, and we can trade long. Now, you might ask, well, what would all of this be? Why would the market go down, come back, and then become long? Well, all the market is doing is all the market will be doing at this stage is just creating a tail on the daily. So if that's the opening, the market has come down and gone up. All the market would be doing. So I clicked on the wrong one. That's a mess. Let's go to that one. All the market is doing is just creating this tail. Okay. So from the opening, go down, come up, it's just a tail on the bottom. So when you look at an higher time frame chart, it's never noise. These tails are not noise. These tails are proper moves that gives you information that you can trade depending on the time frame that you trade in. So if we do end up with the bulls breaking above that level, so that we don't have a double top, that would be one positive for them. But I want to see them not just breaking above that, break above that with a decent follow-through candle. What's a decent follow-through candle? So, for example, here, if you have that breakout above the level and the follow-through, that's decent. Then you want to just see the pullback and look to trade it. I just thought of something that you might ask to say, hang on, but isn't that a higher low there? Why wouldn't we go and buy that? I've seen this bull breakout and the higher low. So forget about the fact that you're in the middle of a trading range. Although that's a decent signal bar, I don't like trading above breakout of any bear candle. Even though there's, so the market open, went down, bulls came back, and they bought into the close above the middle of that candle. That's very good strength on the bulls part. But I don't like to buy above that. If the bulls were strong, they should have put this kind of candle that we had. They should have put that there. Then, if we're not in the middle of a trading range, if that was a pullback, we'd look to trade it. So that's something just to bear in mind. You know, just let's wait for this distant signal bars. If you do a back test, just scroll back through your charts, you start to see these things, and you're like, oh wow, man, if I'd waited for that, you know, this really would have been a fantastic opportunity for me. So that's what when I do when I wait for these things. So wait, the yen, you know, they closed above that, follow through, barely closed above the high of yesterday, but then it failed completely. So, you know, I'm not terribly excited. There is a measured move in the trading range, and we're coming to talk about that. So while we wait, you know, it's just 10 after 5 past. I want to just focus on measured moves for now. I want to take you through measured moves and just show you different time frames, different levels, why a measured move is important and why it is something that you just need to start to put on your charts. You might find, depending on how you trade, it might correlate to, I don't know, maybe another indicator that you used, and that's fine. Then you kind of know what we're talking about. Now, let's put some things on the charts and I'll take them off as we go along. We've been speaking about the market going sideways here. And you could see, so that whole, okay, ignore that overshoot. That's it, a trading range, it's a sideways move. The bulls or whoever breaks above that, their first target, the first magnet that the market goes toward, that they try to get to, is the measured move. And if the bulls are strong, they will get to that particular measured move. And you know, the way that you put a measured move in, you just take that fib retracement, mark the bottom of the trading range, mark the top of the trading range, and that's your measured move. So, but what I've done, just if you want to just keep a note of it, if I go to the fib levels in order to create the measured moves, okay, I've deleted some of the defaults. And all I have is at level 0, at level 0.5 is 50, and at 1 it's 100, 50%, 100%. That's it. Then in terms of parameters, I just take off the ray, you know, so I can just restrict how far the lines go. Visualization, you know, in all time frames. Then you can just choose whatever color works for you, whatever you want. Okay, so that's how you set it up. So it's this tool here, the Fibonacci retracement, Fibo levels 0, 0, 0.5, 50, 100. Everything else just delete, and that's it. Okay, remove the ray, visualization, all time frames, common. You can choose the color, you can choose the way you want the lines done. That's just up to how it works for you. So that's a measured move on this. And I typically want to just leave it here until it is breached at some point. Okay. Now, here's what's interesting about price action trading. You start to see these patterns and they start to give you information. So here I've said to myself, what happened to the bulls? Why did they fail to break above that? So we've kind of gone sideways, we broke above the trading range. We had good follow through and the breakout above the trading, which is good. We didn't follow through here, so I'm not too excited about jumping into any longs. But it came back and they tested again the breakout point. Okay. So they tested the breakout point. That's good for the bulls. So we have a little bit of a small trading range in there. So if the bulls are able to break above that, how far are they going to go? Well, they're not going to go marginally above 2 pips at best. Okay, so Am I going to initiate a trade for a too big profit or whatever? No, I'm not going to do that, you know, because the market is telling me, it's giving me information that, okay, although we failed to break above, we broke above the high of yesterday, it did not a follow through, so it's not a strong breakout, but we still broke above this trading range and we still had distant follow through, pull back to test it. Market is saying there's a magnet there that the market wants to get to that level, but doesn't give me enough profit to trade. Why doesn't it give me enough profit? Good question to ask. Because if I was to take that, my stop is gonna go here at the beginning of the breakout. If I'm gonna try go for 1.1 at least, it's gonna be way above there. And there's nothing giving me the confidence that we'll get there. So that measured move just gives me information. So the market gets there, I'm not going to be surprised. If it gets there and I get a two-bar reversal, then I'm going to say, okay, this is fantastic. Broke above the trading range, created a little double top. So there's another little bit of a wedge there, 1 up, 2, 3. Then I'm just going to look for a lower high to go short. But I'm not surprised in saying why is the market turned, because there is logic and reason to the market turning there. Now, I wanna look at a few examples. Let's just go back to the Canadian. Okay, just put up the monthly time frame on the CAD. That level, I think I marked it earlier of the day, but I can mark it up monthly. It's most visible. So market broke above this trading range here, but it turned, right? And then we came back and we created this particular month here in September last year with a double bottom. And at that stage, you know, question would be, well, are the bulls going to resume or not? But then we had a reversal and the market starts to break to the downside. How far is this going to go? What's the potential? What's the market trying to get to? Where the market is trying to get to is the measured move of this trading range here, you know, this double bottom and that high, and that will bring us to this level, to down 1.2309. So that's where the market may be trying to get to. Now, I've just kind of scrunched up so we can see that level. The market gets to, it would not be a surprise, right? Let's see if we can see a little bit clear. It wouldn't be a surprise. Why wouldn't it be a surprise? Because it's the breakout point. You know, we had a break above the trading range, pullback, and this is a point where the market broke out above this lower trading range. So the market, if we try to make the measured move, we'll be testing that breakout. That breakout has not been tested, so that wouldn't be a surprise in terms of the market getting there. Now, because we're trying to show measured moves and what could happen at measured moves and why. Because the way you got to think about it, someone is creating the potential for the measured move. It's not random. There's no random stuff in the market. There is a lot of players in this multi-trillion-dollar market that we play in. A lot of institutions, governments, countries, robots, whatever it may be, and call it the large institutions, can see all these levels that are visible on the charts. See it by the computers or see it just by looking at it. And while the market moves towards it, they can also create moves that create patterns. If the patterns are broken, could lead to a measured move to test a particular area. I don't know if that makes sense. So here's a classic one, for example. So we had this law here, tested the high law, okay, and created a trading range. Market came back and tested that and created a double top. Now, at that point, we have a larger trading range here. We have the double top, we have the double bottom. What would happen? You know, what are the large institutions thinking? Hang on a second. If we break beneath here successfully and we have a pullback and test and all of that stuff, where could the market go? Well, the market could go possibly measured move. That becomes the measured move becomes a target that the market is pursuing. And that measured move, surprise, surprise, is a key law on this chart. Okay, we got to this law in 2011. We tried to break above a big tail. So the market may be saying, okay, we're going to create a pattern here. Through interactions, people benefiting, buying, selling, and all of that stuff. But if we break beneath this trading range, that's the target. That becomes a key magnet. That's an interim key magnet. That is important for you just to mark at any time frame, any time, at any level that you're trading. So that when this starts to appear in view of trading the daily, trading the weekly, trading the hourly, it's not a surprise if we start to get acceleration towards them. Now, what do I mean by acceleration? Sometimes out of nowhere, you have these sudden moves, which are really quite aggressive. Like, what has caused it? Is it a news event or whatever has caused it? But it's a sudden dramatic move, and that sudden dramatic move leads to a test of a previous level. Okay, so it's almost like in this case, the market gets vacuumed up to a particular magnet. Now that doesn't happen randomly. When that starts to happen, it's opportunities for you if you're trading on a lower time frame that you can see higher and higher closes for you to take a trade. Just decide where your stop goes, take a trade, because you know the market should be trying to go and test that particular level. Then you set your profit just beneath that. So measured moves show you where the market is likely to go. The most important thing is if you are in a trade, they're giving you an alert of where to aim to take profits, so you can maximize your profits. You can see the measured move. If rather than just continually convince yourself, tell yourself, unless I see a clear reversal, and at some stage we'll talk about trend reversal patterns, so you can know, okay, I'm in a trend reversal pattern, let me take my profits. But unless I see a clear reversal, I've got to continually convince myself just to have the inner strength to hold on, hold through any pullback until we get pulled to that measured move, so I can maximize my profits and get out of that. Okay, I'm just putting back the daily time frame, and I want to take you again. Okay, so let me just give you another insight into measured moves again. Let's looking at our own particular time frame, the time frame that we are trading. So, you know, we had this this test of the breakout that we spoke about, and you would have clearly seen there is a low and there is a high. Now, if the market breaks out of this, how far is it likely to go? Okay, if the bears are strong, they want to go to a measured move beneath the low, and the measured move would be here. So we kind of realized, well, we couldn't take any trades because we didn't get the setup. But what a measured move does is, you know, you're sitting there and saying, okay, I can't quite see a trade to take. Oh, but my goodness, look at this. It's broken through beneath the low. If you say there's a follow through, let me just take the trade. Now, there is no room for profits because the measured move is only 5 pips away. If the bears are strong, even though we didn't get a setup, they will test that and close beneath it. And then we'll have to wait and see if we get a pullback that we can still trade within the zone that we're trying to get in. But now information is provided to us at this stage. We're saying, but okay, we didn't take the trade because we didn't get a setup. But where are the bears? If they are strong, surely they should have really reached the measured move. They failed to reach the measured move because the bulls are much stronger. So the bulls have turned the market at this stage. Now what we have is a new, we have this high and we have a new low. And earlier on we were talking about see whether we get a double top here. Market didn't quite get to that. So we gotta wait and see, if we get another test there because we didn't test it, which is fine, but we didn't get a decent bear reversal. So that's a high that's close and close enough that you can't trade that. Rather wait and see if you get a proper setup here. Let me talk about proper setups. I want to see as close approximation as possible. So this is a close approximation to say market tried to test that, it failed. So I have my first double point, my first point of a double top here. There is the second one. There is nothing for me to trade. I gotta wait and see if I get a test of that to create another double top, or if I get if it's bear buys, if I get a lower high. I have to get a lower high for me to trade this low. But at the present moment, what could happen with measured moves? Well, if the bulls are strong, that's how far we can go. Okay, it will still fall short of the high of yesterday, but if the bulls are strong, they will have to break above this double top level, break above the open, which will be fantastic. And if they've given us a follow through and we get a pullback, we know this higher low now becomes our stop level. And depending where we get the pullback, we can take a 20 pip stop and trade within the try and get one-to-one at least. But you could always, take a bit of profit out and wait to see how far you go. Alternatively, because of the double top, if I get a test again here in the lower high, it doesn't have to be a perfect test because now I'm looking for the lower high. So it might just be a couple of candles and then a 2-bar reversal. If I get that lower high here and I'm near the top of my trading range, very happy to take the trade, whatever it forms in here, put my stop above the high of the open of the day, so it's probably a 15 pip stop depending where it sets up. Now if I do that because of the double top and because of the potential measured move now from this particular move, where would my ultimate take profit be? Where I ultimately want to get will be here. Okay, so you can see if we got somewhere within here, a lower high, and we have a 15 pip stop, we're talking of a potential 4-to-1. You might take some of your profits out here, which is fantastic. With the breakout pullback, you can enter again, but you're aiming to get to here. So at this stage, it really is still worthwhile to wait. But that's an example of a measured move. So just looking at the currencies that we're trading again, just one quick look one more time. So I want to see what's happening. This is very interesting for me because that's an area where I might get a double bottom Okay, and if I do get the double bottom forming on the euro, then all I'm waiting for is just a high low of sorts. Then I'm happy to trade that. So my three push pattern could be 1, 2, 3, and then the double top, or it could be 1, 2, double barrel. So this is in a good zone to wait and see what we get. And if we do get that, now that we have a bit of a sense of measured move. So this was from an earlier move. Let's move it across there below. In this particular pattern, there is the high. So if I was to get my setup and take a trade, let's take some of the profits there if you want, if you trade it full risk. If you breakout, pull back after taking a bit of profit, you can take the entry again, put your stop on the technical level, which you can talk about. But your potential would be quite still. The measured move itself is 40 pips. So if you get the setup, depending where you get the setup, you're looking at a pretty decent move. But we just got. I'm just chuckling to myself because the waiting is the most important part. We just gotta wait. Just gotta wait. Okay, I'm not gonna put all this on. So you could say, so move. There's my break beneath the trend line. First push, second push, third push. Let's see what I get. Or you can leave it there. The point is, all we're looking for is that extra touch here to give us the double bottom. And then if you have a double bottom, then just gotta wait to see if we get a high low. Okay, so that will be the potential move. Now, 60-40, 40% chance, all of this might not work after this rating. We may not get the double bottom. We might get a very strong breakout. Remember, for the breakout to be strong, is a strong candle breaking out beneath stuff. I need a follow-through strong bear candle closing on near its low. Then I know I've got a decent breakout. Then I gotta just wait for my pullback, which could be 1-2 legs back to test the breakout point. Get a two-bar reversal or an inside pattern, whatever kind of pattern that I'm looking for, and then trade. So if we got the bear breakout, talking about measured moves, that's what you'll be seeking to get to. Okay, still within the low of yesterday, but if the bears are strong enough to get there, you might get a pullback, moving average, and attempt to get to that low. So that's on measure move, guys. Do you wait for the candle to break? That's for the USD card. Okay, do you wait for the candle to break the EMA? Okay, so here what we said we're looking for is I want to see a lower high. If I understand your question correctly, because I have a double top, do I have to wait to see the candle breaking beneath the EMA? Not necessarily. So here we've had a couple of breaks with tails. So let's assume with this candle here, let's assume the market turned on this bear candle without breaking beneath the moving average and came back and gave us the lower high. I'm going to take that trade on the strength of I have my double top and now I have the lower high. But remember now with the lower high, I just want to see a decent two-bar reversal pattern, then I can trade it short. So it doesn't have to. If it breaks beneath that, that's fantastic. It's just strength to the base, right? And the base put a close even better. So I don't have to do that. At some point we'll talk about when you're in a trend. Let's assume we didn't have all of this, but we're in a bull trend and the market accelerates to a level of resistance. but it goes there with 3 pushes, but very tight. We call that a parabolic wedge. When you see that, but that's only in a trend, and the market turn, it gives you a 2-bar reversal. You don't wait to get a lower high. You take that trade, put the appropriate stop, because the market might just carry on all the way down to the moving average and gives you the first pullback beneath the moving average. You should be way below that. But that's in exceptional cases in a trend. We don't have that here. We're in a trading range. We are just now waiting to see, get a bit of a resumption, get a 2-bar reversal, and then let's take our trade. So you said USD meant, let me look at the euro as well. You can do that. Okay, so for the euro, the question again is, do you wait for the candle to break the EMA? Now, if we get this is all good news here for our current mindset, right? So there's a small trading range that's forming here. The market breaks beneath that, it might come and test that. So if we get a double bottom here, or if we get a candle breaks and it pulls back, because we're going to pull back and close within here, it's got a tail, that's fine, because we know that's just a measured movement, that type of measure. It should get there. So let's say you get that, and then you get a higher low here, you can take that trade. You don't have to wait for the market to give you, to close above the moving average. If you don't take the trade, if you don't like to take a trade, even though you see the pattern, and you don't like to take your trade still below the moving average, hold in your mind the trade, the fact that you are now trading out of the bottom of the trading range, going long. Then you wait for the market to put a close above the moving average. When the market puts a decent close above the moving average, because you want to take your trade off the moving average or beyond moving average, you wait for a decent candle that closes significantly above the moving average. Then you can put your order above that. But what you got to bear in mind is at that stage, if you're taking that break above the moving average, at that stage your stop is down here. If you want a tighter stop, then you don't take that candle that breaks above the moving average. Okay, you have to wait for a pullback that tests the moving average, then a reversal candle that allows you to put a tighter stop. So I hope that answers your questions. So guys, if there's any other questions, just kind of pop them into the chat box. Because we'll be moving to the close of this session. Again, just to remind you, for next week, the session starts 30 minutes earlier, so it will start at 5:30 same time. That's 30 minutes earlier that we have, and it will run for an hour. So it will be quite punchy, quite jam-packed, because we're going to go through the whole setup as well. Other thing that the admin team is going to help me with, we've spoken about a lot of setups that we are looking out for. I'm still in the market for the rest of the European session, and all the way through to the first couple of hours of the US session. Typically, I come back towards the last couple of hours before I go to sleep to see what's taking place. And then during the week, I just get up. I get up, and I love to trade that part of the Asian session when the Tokyo Stock Exchange is open, because I'm always looking for. I'm trying to get in and find the low of the day or the high of the day, because if you can get that, and the market moves in a direction out of the Asian session to the European session, I mean, you could have a very, very good return on that particular day. So for example, reason I get up to try and trade don't always do it, this body sometimes stays up to talk to the family, etc., and then you're tired. But just think about it. If you were able to find your entry here, somewhere within here on this day, because remember what you said earlier on, market creates tails. Market is always trying to create tails. It would open, go down, come back. If you're able to see your pattern and take a trade, and then be able to hold it right up to the end of the day. I typically close all my trades, and then, that's what I do. Then I pick up the trade the next day. I very rarely, once or twice, I've done that, but I don't like to do it. I don't like to hold trades overnight. But in that particular day, if you're able to, when the market does, it's creating its tail, whether it's in the Asian session or the European session or the case may be, and if you're able to hold it, go to work, do whatever after you put your stop, and come in and have a look at it, you may be able to come back. You get the European session or the US session. You get good returns, plus you can always add in as the market is moving. So that probably explains why I try and force myself to get up into all the opens of the session. And yes, sometimes I just trade the morning part of the Tokyo Exchange session, 2.5 hours. When I go back to sleep, if there's nothing happening, just go to sleep. But I'm trying to get, because you try to turn a lower time frame, if you are patient to get the moves, the returns can be quite dramatic. But it's the waiting, it's the searching, it's looking for, and then it's the execution. Okay, so I put up the hourly time frame. Remember I said always look at hourly to see if there's any information I get. Again, just having a quick look before we start to wind down. The yen, the market has gone up, but I don't see how I could have entered into the trades at this stage. So when I get to the measured move, it accelerates bottoming. What I then do at this stage, so if it accelerates and there's follow through, I say, okay, so the bulls are strong, then all I gotta wait for is now pull back to the moving average. So at some point we'll talk about the complete strategies. I keep, just for information, looks quite messy, but my strategies are written on a piece of paper. I remind myself, I call them my trading products. It's trading range tops and bottoms, and there's subcategories in terms of how I trade that. Then I'm either trading a reversal up or reversal down from a hidden support level or a hidden resistance level that comes out of the measured moves that we're talking about. So next week in the hour session we got, I'm going to be talking about this particular strategy: reversals up or down, and market hits that measured move of a trading range breakout. How do we take a trade out of that? So I'll be talking about that particular strategy next week, giving you examples, and hopefully, in the week until then, there will be a few real trades that I can point you out to say this is what we did. The third strategy, which is what I'm referring to here, is when the market has moved and I've not seen how to get in early, then I wait for pullbacks to the moving average, the 20 moving average. I have to wait for that pullbacks, and those pullbacks, the moving average, the market has to come back to it in two legs, which high one, high two. So the first high, first pullback that breaks a high, and then the second pullback. We'll talk about this as we go along, or a wedge pullback to the moving average. So if the market accelerates here, okay, I mean by breakout, follow through, and I say, okay, so we are in a tight bull channel. I didn't see a trade. I don't ignore it. Now I'm just going to have to wait until it is accelerating to that move. Let's see if it closes above both this move and that move. Let's assume it does. That's a decent breakout. Then I want to see the follow through of that breakout. Then I know I'm in a bull trend and I'm just going to wait for the pullback. So the third strategy will be pullback to the moving average in a trend. So it has to be a trend, a confirmed trend. Then the fourth strategy is small pullbacks. So when you have a trend, you see this part of the chart here. If that's all we had, and the market goes up, goes down, goes up, goes down, and it's very, very tight, and you just don't know. You can see it's going up, but there's no big candles, and it's almost an upward slanting or a downward slanting tight trading range. How do you trade that? And I'll talk about that. This is where I put up the 10 moving average and try to find trades. So that's the fourth strategy. And the fifth one, which interestingly I like, is major trend reversals. But major trend reversals is an interesting one because unlike everything that I've spoken about, which are minimum 60% or at best 60%, they can be 70, 75, depending where you're taking the trade. For example, if you're taking a pullback in a trend and it's set up correctly, that's typically a winner at the moving average. That's a 75% probability. But on average, I talk 60-40. But major trend reversals, which can give you huge return, those are 40, 60, 40%. 4 out of 10 you win, but when you win big. The other 6 out of 10 you have to manage tightly. So those will be those are my five trading products that I bring to the market, and whenever these appear, then I take my trades. So we literally have just a few minutes, but I'm going to just go check again where we're at. So there's our yen. So now we're at the level where I would love to get a 2-bar reversal here to confirm the double top. I need to see some kind of a 2-bar reversal, something like this or something like that, and I know the bears are strong. And then I'm going to look to go short. But I need to see that. So I like this. But again, because I like it, I have to wait to see it actually form and shape. But that's looking pretty decent. The euro is very interesting. So we had a break beneath the level where we were looking out to see if we get a double bottom. But we're not surprised, right, at this stage. This breakout is very strong. And if the bears can close beneath it, then we know we have a confirmed bear breakout. That confirmed bear breakout means now my whole thesis of a double bottom, high low is gone. The bears have changed the market, but I'm not going to take that trade. Now I have to tell myself, okay, George, don't look to buy anymore whatever you get, because if the bears close beneath this particular candle, they are confirming the breakout. Now I need a pullback. What a way to see what pullback I get to the moving average. But because I'm at a measured move with this little trading range that you put up earlier, if the bears don't close beneath that decisively, if I get whatever, a reversal candle, a bull candle, weak doji, then my case is still strong, and I have to just wait for price action to play out and see if I'll get a higher low here. So that is where we're at, guys. If you have any questions, just pop them in. Otherwise, the administrators will be able to take over the show shortly. And we'll see you next week. We will definitely see you next week for the hour show from 5:30 for an hour. We'll just keep an eye